Well, I mean, it's been a tough year for sure. And I think, the word pain, the Federal Reserve's preferred noun, has really been most acutely felt, Scott, with the most conservative investors. Because as of now, you have the Barclays Ag, which is a Treasury and investment grade index, down close to 14%. A 60-40 portfolio is down 20%, which has actually only been eclipsed by 1931 in the Depression. And so this is where we are today, where, equities have not done well. But really, to me, this has been a story about the bond market, really giving conservative investors a 1-2 punch. I think, unfortunately, this next couple weeks is going to be dicey. The Cleveland Fed, who puts out CPI forecasts, they came out earlier this week, and they showed that October CPI month over month will be up 0.3, which if you look what that means to a year over year, Scott, that's going to give us an 8.2% if that number comes to fruition. So I think for investors, you have to stay defensive, ride this out, because it's really, I think, going to continue to be a tough market.
I got to bring this note to your attention because, anytime J.P. Morgan's Marko Kolanovic publishes, and he often publishes during our hour, he has been making the case for the last many months that he's been more positive than most, and he has given you all of the reasons why he has played counter to what the consensus narrative has been. He just dropped a note that said, quote, "We're increasingly worried about central banks making a policy error and of new geopolitical tail risks following the destruction of the Nord Stream pipeline." He had been constructive. He'd been more positive than most. Now he says, and he goes on here, and this just dropped, "Even if a mistake is avoided," he says, "a delay will likely be introduced for the global market and economic recovery. A second assumption behind our positive view is now at risk. It all amounts to throwing rocks in glass houses. 2022 price targets are at risk, may not be realized until 2023 or when the above risks ease." You tell me, Weiss, I mean, is this maybe one of the last bulls standing, throwing in the towel?
No, not at all. I mean, it's somewhat encouraging to see, but, sometimes markets are easy and sometimes they're difficult. The only time they're really easy is if you go back to when the Fed started easing after the housing crisis and Tepper came on and said, hey, go with the Fed, the market's going to explode, because he focused on the Fed. So the market, and it's more difficult now, granted, given what we've had, but the Fed's come out and said, hey, we're going to keep going. They said it today. They said it yesterday. So you can look for tea leaves. You look for signs. You can look at the length of women's skirts. Is it a buy signal? All that's pablum. It means nothing. The only thing that means something is that there is no playbook for the economy where we are, because we've never had a Fed that is so intent on cutting back on their balance sheet, on raising rates. That's all you have to know. And the pain has not been expressed yet by corporations, except Nike today. So people come on saying, buy the dip. Well, Nike was down from its peak in last November at 180 to 100 before today. It's down another 10% today. Why? Because the consumer's weak and because costs are up and they're getting squeezed. So that's going to keep happening. So you can't buy the dip. The only thing you got to worry about right now is when is the turn going to happen? And you'd be so much better off waiting for that turn to occur, missing the 10%, and that may be a year from now. But the only thing that's changed in my thinking is I've got my AirPod in my right ear instead of my left usually, but I'm sticking net short for now. I'll get hit by some rallies like this morning, but I'll stay net short.
Let's say this, Weiss, okay? You've been negative for longer than most. I totally get it. But you didn't really address the issues in the Kolanovic note, which I asked you about. And the primary one, which you have not gamed out in your negativity through these last many months, is this worry about central banks making a major policy error. And after what happened in the UK, the ante of that was upped in some people's minds, enough so that you had one of the last bulls standing, if you will, suggesting that now it may not work, because that's a principal risk at the same time of when you may get a geopolitical risk piled on top of that. That's how the risk gets elevated.
Right. And so shouldn't that make anybody more negative? I can't be more negative. But if you're a bull and you're listening to what he's saying, and he's absolutely right, and all the bulls are saying, hey, the Fed's going too far too fast, that's a reason that they should say, you know what, maybe I shouldn't be buying dips. Maybe I should keep my cash and wait. So you take the negative case that I've laid out, and then you say, okay, this makes me really wake up like it did for him. So unfortunately, the markets don't really trade in what sentiment is. They're trading on what monetary policy is and fiscal policy. Fiscal policy has been very negative because it's been inflationary. So the Fed's even got to work harder to take it down.
Right.
So anything that he said, I'd say welcome aboard to the negative view, and that you're still not there yet completely. You should be more there.